Did you know shares are coming off their best week of the year? In fact, they are just shy of $190 now. Let's ask CNBC contributor and Apple shareholder Jason Snipe of Odyssey Capital Advisors. Nice to see you. 52-week high on this stock is just under $200, 198. Is this phone going to push us there?
I'm not sure about that, Scott. I think a lot of the return that we saw last week was indicative of some of the softness we saw in economic data, where a lot of the mega cap tech names caught a little bit of a bid last week. So for me, as it relates to this event, I think, as I look at the 5G cycle, 5G has been around for several years now. And if I'm looking at the carriers as an example, I don't see a lot of the incentives being put out there for companies for the consumer really to plug in and be able to take advantage of these incentives that are not really there. So for me, I think this is another event. We'll look through the rest of the year. The stock is to some of the commentate that we saw earlier. The stock is trading at 31 times forward, and it's only a long-term growth of 9%. So I think the multiple is definitely in view right now, and I think that's what the concern of the market's looking at going forward.
Well, are you suggesting that you also think that Apple's too expensive?
I do. I think it's pricey. It's hard to justify a 9% growth rate, and especially revenue deceleration that we've seen over the last couple quarters at 31 times forward. But I think Apple has been a safety trade. Tech has obviously run a ton this year, and Apple clearly has benefited from it. And listen, the consumer is still relatively strong, and I think Apple is always a bellwether stock for the consumer. And I think when the consumer is healthy, Apple is healthy, and Apple is strong. Although I do think the multiple is a little bit rich at this time. Also considering it's above its 3-year average as well.
I mean, you sound, frankly, like somebody who's trying to justify taking profits in the stock, not someone who's bullish and continuing to hold at these levels.
Well, I mean, for us, it's something that we continue to review. Clearly, the stock has done very well. It's up 44% this year. It's approaching $3 trillion in market cap. But for us, again, as we look at a lot of the macro data and the consumer willingness to lean into some of these prices, and iPhone sales have been somewhat muted. And I think that's definitely a concern for us. But services has been very strong. And even in the last print, I mean, Apple printed just about a month ago at this point. China has grown a little bit, but now there's obviously been there's been concerns all year with China. So for us, I think it's something that we continue to evaluate, but it still remains a core position for us as we move forward.
Do you see other mega cap valuations as extended as well?
You know what? I think a lot of them, obviously, this year has been about multiple expansion. So a lot of them have been stretched. And I think to your point in the earlier segment, names like NVIDIA who have actually gotten cheaper because their earnings has been there. So I do think a lot of these tech stocks have moved a lot, and that's obviously the reason for the multiple expansion. I think there's areas of the market that I think are primed for some new leadership and new growth, and energy being one of the examples for us as we start to look to allocate funds in other places of the market.
Well, because, I mean, you've got, Alphabet, Amazon, Microsoft, NVIDIA itself, and you're all over this area. Is there another stock that sticks out like a sore thumb to you within mega cap that looks like it might be a little stretch? I mean, I'm looking at Microsoft, for example. I got a PE of 34, north of that.
Right. So it's funny that you mentioned Microsoft. Microsoft is actually the one that I would say is a little bit stretched. I mean, they took advantage of kind of this AI-themed bull that's taken place throughout the beginning of this year and year to date. So I would say Microsoft actually is the one that's a little bit rich on valuation. Amazon as well, but we continue to like the cloud business in Amazon and some of the other things that they're doing with the margin expansion there. So I think for us, yes, I think it would be Microsoft, but we continue to hold all these names. I think you have to have a barbell approach, with the mega cap tech and some of the more cyclical oriented areas.